It shows up the month you turn 65. A pile of mail thicker than usual. The AARP card you didn't ask for. A Medicare packet with 100 pages you're supposed to read, and somewhere in that stack, folded in with the grocery flyers, a notice from your county, the kind you've been setting aside your whole adult life because it always said the same thing. Here's what you owe. So you set this one aside too, because that's not for you yet. That's the government's business, and you'll deal with it when you deal with it. Here's what you don't know, sitting there with that unopened envelope. Right now, this month, in New Jersey, somebody exactly your age is getting $6,500 knocked off that same bill. Not because the state felt generous, not because they earned some special status, because they opened the envelope, found a form, and checked a box that most people throw straight into the recycling. $6,500 for the price of a signature. And that's just one of them. Because the thing nobody sits you down and explains, the thing our whole generation was somehow supposed to figure out on our own, is that turning 65 doesn't make anything automatic. It just makes you eligible. There's a difference, and that difference is worth more money than most people leave on the table in a year. There are 5 bills like this. 5 things you're very likely overpaying right now, today, that you have every legal right to reduce, delay, or in some cases skip entirely. The moment you know the form exists. Not loopholes, not tricks, just the paperwork nobody handed you. So before you set that envelope aside again, let's open it together. Think about how we were raised to see the government, not as a helper, as a bill collector. The IRS was the letter you dreaded. The county was the tax you paid. Nobody in that world was ever going to call you up and say, "Hey, did you know you qualify for a break?" That's not how it worked when we were kids watching our parents at the kitchen table, and some part of us still assumes it doesn't work that way now. And here's where that assumption quietly costs you. Because a few things at 65 really are automatic. Medicare enrollment, if you're already on Social Security, that one just happens. So your brain files everything else under the same heading. Turn 65, the system knows, the system takes care of it. It doesn't. Almost none of it does. Every single break we're about to walk through has the same shape. It's real. It's legal. It's often worth thousands. And it is sitting behind a form that you have to find, fill out, and file, usually with a different office, in a different building, on a different deadline than you'd ever guess. Miss the form, and you don't get a warning. You just keep paying, and the money's gone, and nobody ever tells you it was avoidable. 5 bills. Property taxes, the federal tax on your Social Security, the state tax on your Social Security, jury duty, and the one Medicare penalty that can follow you for the rest of your life. Different offices, different rules. One thing in common, not one of them lands in your lap. You go get it. Let's start with the biggest one, and the one with your name already on it. Your property tax bill is the one that feels the most permanent. It went up last year, it'll go up next year, that's just what it does. Except after 65, in most of the country, that's no longer true. And the size of the break depends entirely on one thing you probably didn't choose for tax reasons at all, which state you happen to live in. Take Texas. If you own your home and you turn 65, the school tax portion of your bill gets frozen, locked at whatever you paid the year you turned 65. Your home's value can climb for the next 20 years, and that piece of the bill does not move, not reduced once and then creeping back up, frozen for as long as you own the place. Go up to Alaska, and the first $150,000 of your home's assessed value is simply exempt. The tax skips it entirely. In New York, a program called SCHE was just expanded so that qualifying seniors can knock off up to 65% of their home's assessed value, up from the old 50% cap, starting this tax year. In Cook County, Illinois, if your household income is under $75,000, you can freeze your assessed value so it stops chasing the market upward. And then there's New Jersey, the $6,500 from the opening. It's a program called Stay NJ, a credit worth up to $6,500 a year, and the income ceiling on it is $500,000, which is unusually generous. If you're a New Jersey homeowner over 65 and you're not in it, that is real money walking out the door every quarter. Now, here's the thing I keep noticing about all of this. The states with the biggest breaks are almost never the ones people are talking about at the dinner table. Everybody's got an opinion on where taxes are high. Almost nobody knows where the senior relief is quietly sitting, waiting to be claimed. And none of what I just described, not Texas, not Alaska, not New York, New Jersey, or Illinois, none of it is automatic. Every one of them runs through your county assessor's office, and every one of them requires you to apply. So whatever state you're in, that's your first move. Not the mailbox, the county assessor. Look up senior property tax exemption and your county name, and find out which version of this you've been walking past. And if you've already done it, if you found one of these and it worked, do the rest of us a favor and put your state in the comments, because this is exactly the kind of thing we only ever learn from each other. The second bill is one a lot of people don't even realize is a bill until it hits. The federal government taxes your Social Security. Not everybody's, and not all of it. But the line where that tax kicks in is one of the strangest numbers in the whole system, and once you understand it, you'll see it differently for the rest of your life. Here's how it works. If you're single and your combined income is under $25,000, your benefits aren't taxed at all. For a married couple filing together, that line is $32,000. Go above it, and a portion of your Social Security becomes taxable, up to 50% of it in the middle band, and up to 85% once you climb past $34,000 single, $44,000 married. Now look at those numbers again. $25,000, $32,000. Do they sound low to you? They should. Because here's the part almost nobody knows. Those thresholds were written into law back in 1983 and 1993, and they have never once been adjusted for inflation, not a single time in 40 years. Follow that forward. Everything else moved. The price of groceries, the cost of a house, the size of the average benefit check, all of it went up with the decades. But the line where they start taxing your Social Security stayed frozen exactly where it was when a gallon of gas cost $1. So every year, a little quietly, more retirees cross a line that hasn't moved, not because anyone raised your taxes, but because the rule was designed to stand still while your life didn't. You think the rule got stricter? It didn't. It never moved at all. You did. And there's one lever worth knowing about here, at least for now. There's a temporary senior deduction, $6,000, created under recent tax law, in effect for the 2025 through 2028 tax years. It lowers your taxable income, and for someone hovering right around that threshold, it can be enough to pull you back under the line where your benefits get taxed at all. It phases out at higher incomes, and it's not permanent, so it's worth asking a tax preparer about while it's here. That's the kind of thing you check on purpose, because nobody's going to check it for you. Now, that federal tax we just talked about, that one follows you no matter where you live. But there's a second layer on top of it, and this one is pure geography. Your state might tax your Social Security too, or it might not touch it at all. And here's the good news, because this is the one beat in the whole video that's mostly relief. The vast majority of the country leaves your Social Security completely alone. As of this tax year, 42 states plus Washington, D.C. do not tax your benefits, not a dime. That includes the states with no income tax at all, places like Florida, Texas, Nevada, and Washington, but it also includes dozens of states that do have an income tax and simply choose to exempt Social Security on purpose. Only 8 states still tax it in any form: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. And even in those 8, most of them shield lower and middle-income retirees with income limits. So plenty of people who live there still end up owing nothing. And that list keeps shrinking. West Virginia was on it until this year. It finished phasing its tax out, so if you read an older article that says 9 states or 10 or 12, that's why. States have been racing to drop this tax to hold on to their retirees, and the map gets a little friendlier almost every year. So the move here is simple. Find out which side of that line your state is on. If you're in one of the 42, that's a settled question. There's nothing to file, nothing to claim, it's just not taxed. If you're in one of the 8, the real question becomes whether your income is low enough to skip it anyway. And that's worth 10 minutes with your state's revenue website or a tax preparer. Because my state taxes Social Security and I personally owe tax on mine are 2 very different things. The fourth one is different from the others, and I'll be honest with you, and it's the one that always makes people smile a little when they find out. It's jury duty. Somewhere in your 50s or 60s, that summons stops being a mild annoyance and starts being a real imposition. A full day at the courthouse, maybe more, sitting on a hard bench, when your back already has opinions about hard benches. And what almost nobody realizes is that most states will let you out of it, purely because of your age, if you ask. It varies by state, the way everything on this list does. In a couple of states, Mississippi and South Carolina, the age where you can be excused is as low as 65. In about 20 states, it's 70. In others, it's 72 or 75, and in a handful, you have to reach 80. So there's no single national number. You check your own state's rule to find yours. But here's the part that matters, the part that's the same as every other bill on this list. It is never automatic. The court does not look at your birthday and quietly take you off the list. That summons will keep arriving year after year, and you will keep showing up for it, unless you do the one thing almost nobody does. You check the box. There's usually a line right on the summons itself, an age exemption you can claim, or a simple written request you send back. 30 seconds of paperwork, and you're done with jury duty for good. And I'm curious about this one. So tell me in the comments, did you already know you could opt out at your age? Or did you find out the hard way, sitting in a courthouse hallway at 7 in the morning wondering why you were still on the list? Because I have a feeling a lot of us are in that second group. And that brings us to the fifth one. And I want to slow down here, because this is the only bill on the list where getting it wrong doesn't just cost you money this year. It can cost you every single year for the rest of your life. This is the Medicare Part B penalty, and it's the one I most want you to understand before your birthday, not after. Here's the trap. Part B has a standard premium. For 2026, that's $202.90 a month. If you don't sign up for Part B when you're first supposed to, Medicare adds a penalty, 10% on top of that premium for every full 12 months you delayed. And this is the part people don't see coming. That penalty isn't a one-time fee. It's permanent. It gets baked into your premium and you pay it every month for as long as you're on Part B, which for most of us means the rest of our lives. Delay a few years without a good reason, and you've quietly signed up to overpay forever. Now here's the good news, and the reason this is a skip and not just a pay. There's a completely legal way to delay Part B with no penalty at all, and a lot of people qualify for it without knowing. If you're 65 but you're still working and you've still got health coverage through your current employer, a real, active job at a company with 20 or more employees, you're allowed to hold off on Part B, penalty-free, for as long as that coverage lasts. When the job ends, you get an 8-month window to enroll, and the penalty never touches you. That's a special enrollment period, and it exists precisely so that people who kept working past 65 aren't punished for it. But, and this is the single most expensive misunderstanding in all of Medicare, so hear me on this one, that protection only counts if it's coverage from a current, active employer. COBRA does not count. Retiree health coverage does not count. A plan you bought on your own does not count. Those feel like coverage. They feel like you're covered, so surely you're fine. You are not fine. If you lean on any of those to delay Part B, the penalty clock keeps ticking the whole time, and you'll find out only when the bill shows up with that 10% a year surcharge stapled to it permanently. So the rule to carry out of this beat is simple. Still working past 65 with real coverage from that job? You can safely wait. Anything else? Retired? On COBRA? On a plan you bought yourself? Don't wait. Enroll on time. This is the one where the paperwork protects you, and the silence costs you forever. Before we close this out, one honest note. I'm not a lawyer, not a CPA, not your financial advisor, and none of this is personal advice. It's just the stuff our generation was never handed, so you can walk into your county office or your tax preparer's office and ask the right questions. The forms are real. Your situation is yours. Check it against a professional before you act on it. So step back for a second and look at all 5 of these together. Property taxes, the federal tax on your benefits, the state tax on your benefits, jury duty, the Medicare penalty, 5 completely different offices, 5 different rule books, and yet every single one of them works exactly the same way underneath. The break is real, the break is legal, and the break is invisible until you go find the form and claim it yourself. And I think it's worth asking why it's built that way, why none of it comes to you. Because we weren't raised to expect it to. Think about our parents' world for a minute. The pension that showed up because you put in your 30 years. The union that had a guy whose whole job was to know the rules for you. The company that was supposed to look after you at the end. There was a sense back then that if you did your part, Somebody on the other side was keeping track. Somebody would tell you what you were owed. And then a lot of us watched that world come apart. We watched the pension get frozen or vanish. We watched 2008 take the thing our parents thought was guaranteed and show us it never was. And the quiet lesson our whole generation absorbed from that, the lesson that made us skeptical, self-reliant, a little suspicious of every institution, was this: nobody is keeping track for you anymore. If you don't read the fine print, nobody reads it on your behalf. Here's the thing, though. That lesson stung, but it wasn't wrong. And it turns out to be exactly the instinct this moment rewards. Because these 5 bills, they belong to the world we already learned to live in. The one where you assume nobody's coming, so you check for yourself. The one where you open the envelope. Everything I just walked you through is really just that same instinct, pointed at the paperwork. And it's worth thousands of dollars a year to the people who use it. So you don't need the system to suddenly get generous. You never did. You just need to know which 5 boxes to check. Go back to that pile of mail from the start. The county notice, the Medicare packet, the summons. It's not a stack of things being done to you. It's a checklist of things you get to claim. That's a very different feeling, and it's the one I'd want you walking away with. If any of these was news to you, and I'd bet at least one of them was, do 2 things for me. Tell me in the comments which one you didn't know about, because I promise you're not the only one, and somebody scrolling past needs to see it. And if this is the kind of thing you wish somebody had told you years ago, subscribe, because this channel is basically one long version of exactly that. The stuff our generation was supposed to just figure out, finally said out loud. I'll see you in the next one.